Norm, the one thing that I can see today, as George is just pointing out, is that the best way to explain this in the absence of any good narrative around headlines or news or trend is that investors, when in doubt, just pile into tech. Does it make sense to have the NASDAQ as one safety trade when it's almost at 4.5 times sales in its valuation, piling into tech, the most expensive it's been since .com? What kind of safety is that?
Well, I think that, we have to consider valuation against a backdrop of interest rates. I know it's overplayed, it's somewhat cliched, but interest rates are going to be lower for longer. And when you think about long duration cash flows, long duration assets like tech stocks, there is going to be an impact on valuation, from the interest rate environment.
Wait, well, hold on. The 10-year yield finally moved the past 3 weeks. It's the highest since June.
Yeah, but it's still really low. I mean, it's not zero, but let's call it close to zero at 78, 80 basis points. And this environment, is likely to be followed by more fiscal stimulus. You've been talking about it here for the last half an hour or so. We've got fiscal stimulus, so we've got monetary stimulus. We've got a Fed that really is indicating out to 2023. Most likely they're going to be in a holding pattern. So I'm not saying interest rates are all of it, but I think that you have to consider those and stimulus. And then, we've got, probably some election certainty, if not in the next 35 days, in the next 45 days, the way the polls are looking. Markets, will respond and tend to respond positively to reduced political uncertainty.
So, Norm, that I can see the volatility around huge election risk and chaos seems like it's dropping a little bit here. Both candidates saying they want to spend, so the eventuality of stimulus, it seems to make sense from a logical perspective for being optimistic. But doesn't that still depend on how much, where it goes? And we've got a lot of differing messages on what it could be. I imagine that for the equity market, $3 trillion of just a cash drop would be a lot different for, I would think, maybe I'm crazy at this point, I think there's some connection to fundamentals, but I would think like $1 trillion in flowing through the economy would mean different things for the S&P 500 than, say, 1 or 1.5 trillion that's going straight to airlines or something. I mean, does it make sense for the whole market to surge 4% when we have no idea what the contents of such stimulus now or in 6 or 3 months might be?
Oh, sure. So, you talked about this earlier, that the notion of that we can explain what's going on in any single day is single trading day is pretty hard.
Sure.
I think over the last several weeks and looking forward, the market's discounting. It's discounting whether you want to say it's 3 months, 6 months, or 12 months into the future. So the market is reckoning with the rising probability that this election will not be a protracted Supreme Court type battle like we had back in 2000. It's reckoning with, improving, although still really rough, COVID-19 pandemic. And it's reckoning with hopefully what looks to be, a period of continued recovery in corporate earnings. And you take all that, as well as the aforementioned interest rate backdrop, and I think, combine that, you've been talking about the mega cap techs. I mean, as you know, they've lagged here until today over the last several weeks. So perhaps this is just a bit of a catch-up trade.
I know that some of them fit the kind of blueprint you guys are using right now. I want to make sure, because I teased it in the previous block, Norman. Let's talk about your guys' game of fish you're playing right now. I like your acronym PERCH with 2 R's and 2 C's. I'm going to read through it real quick. Prompt parts, interest rates, as you just mentioned, rates, remote, the work from home, live at home, remedy, which includes some of the COVID health plays, cashless, companies like Square, PayPal, etc., cleaning and home entertainment. Let's start with prompt parts, though, because that's the one that I think most may kind of do a double take here and go, what does that mean?
Well, it means that this whole pandemic has really disrupted, especially in the initial few weeks, late March, early April, and into May, a lot of supply chains, and we've had companies have to basically rework everything. Now that's starting to work, But when we talk, we talk in this particular perch paper, we talk about the importance of less than truckload, shippers like Old Dominion. They're much more flexible in terms of being able to deliver to different nodes. So that's part of the prompt parts theme.
Okay, so you've got the logistics type plays here. I mean, it seems like the prices are going up. These spot rates for vans and flatbeds. I mean, what do you buy? Like a van company, or are you buying logistics centers?
Well, our favorite, and we own it, is Old Dominion Freight Line, which we think is the best less than truckload operator out there. But we do have our eyes on, and I'm not going to mention them because they're being actively researched, but we do have our eyes on some other more, broader logistics plays as well.
Okay, ODFL, Old Dominion, as you mentioned there, some of the rails in this mix too. So, Norm, this is not, I have to, I look at this and some of them are definitely tech-centric, right? As you mentioned, the cashless, PayPal, MasterCard, Visa. You look at Netflix and Activision at the home side. I know that remote work, you've got cloud exposure. You put Okta, Akamai as examples. When we spoke about, quarter, we talked probably quarterly, Norm. It seems like this is a little bit more of a approach that has other companies in there that do have ties to the cyclical economy. I see Carnival in here and Marriott as the potentially challenged places, but others like you've got companies that are still sort of tied to economic recovery as well. So is this a pure play tech, or are you trying to mix in other things here that might have some hedging benefit?
Right. So, first of all companies eventually are going to have to swim in the broader economy. So, whether you're a growth investor or a value investor, what you hope and expect to see over the next, several weeks and several months into 2021 is some better economic growth numbers. It looks like we're gonna see that. We're a growth, we're a very focused growth manager. We do have, a good exposure to technology, but yeah, there's companies outside of technology that should be able to benefit during this upcoming and ongoing recovery phase.
Do you think right now investors have to be wary about being over-levered towards the stay-at-home trades? If does a vaccine or something like that pose a risk to those valuations?
Yeah, I think investors, as always, but particularly now, really have to be selective and really try to be mindful about the companies that they're investing in, and hopefully differentiate between companies that are experiencing disproportionate, I'll call it that, benefit from work from home, from companies that will have, we think, longer secular tailwinds behind them, and that's what we do as active investors and the differentiations that we try to make.